Hello, and welcome back to Explain the Charts, your go-to channel for detailed market analysis. Today, November 16th, 2025, we're diving deep into the dramatic price action of Bitcoin after its recent, intense crash. We'll start with the crucial news driving the sentiment and then jump into a full technical breakdown of the BTCUSD charts. The headlines right now are dominated by fear, with Bitcoin cratering to a 6-month low, trading around the $94,000 to $95,000 mark. This comes after a spectacular run-up in October, where Bitcoin set a new all-time high of over $126,000. So, what's causing this nearly 25% drop in just over a month? The primary driver, according to most sources, is macroeconomic uncertainty, specifically surrounding the U.S. Federal Reserve's upcoming interest rate decision. Market expectations for a December rate cut have plummeted from a near certainty of over 90% down to just a 50-50 chance. Higher interest rates typically reduce liquidity and make investors flee from higher-risk assets like cryptocurrencies. This sentiment is amplified by a broader sell-off in other risk assets, like tech and AI stocks, with growing fears of a potential AI bubble popping. We're also seeing significant outflows from the U.S.-listed spot Bitcoin ETFs, which drains liquidity and adds to the selling pressure. Interestingly, some major players remain bullish for the long term. Citigroup analysts are attributing this dip to a liquidity crunch and are maintaining a price target of $181,000 within a year. JPMorgan is also holding a bullish 6 to 12-month outlook, targeting around $170,000. They make a critical point that Bitcoin's estimated production cost is around $94,000, a level that has historically acted as a strong price floor. Another factor has been the recent end to the longest U.S. government shutdown in history, which had been delaying key regulatory decisions from the SEC and CFTC. While the shutdown's end could bring clarity, the market is still processing the economic data that was delayed. With all that news as our backdrop, let's turn our full attention to the daily chart. As you can see, the price action tells the story perfectly. Here is the explosive move up in October, culminating in that all-time high right around $126,296. Following that peak, we see a series of large, decisive red candles, indicating a powerful trend reversal. The most significant breakdown was the loss of the psychological $100,000 level, which had previously acted as support on several occasions. That level, around $100,000, must now be considered a major overhead resistance. Price has since fallen to this critical area we're in now, right around $95,000. Looking back on the chart, we can see that this exact zone provided strong support back in early May of this year. The lows from May were right in the $93,500 to $94,500 range. This creates a confluence of support, a historical price floor combined with JPMorgan's estimated production cost. This makes the $94,000 level the most important line in the sand for bulls to defend. If this level breaks, the next major historical support isn't until much lower. Analysts have pointed to $87,800 as the next potential target for bears if selling pressure continues. The volume on these down moves has been significant, confirming the strength of the sellers. Right now, the last couple of daily candles are showing some indecision, with smaller bodies, as the market digests the huge drop and decides if this support level will hold. Let's zoom in on this recent price action since the all-time high. Here you can more clearly see the topping formation and the aggressive nature of the sell-off. Notice the sharp rejection on October 10th, where the price dropped over 7% in a single day. Then, after a period of consolidation and failed attempts to rally, we see the decisive breakdown on November 14th. That candle alone represents a drop of over 5%, slicing through the $100,000 support like it wasn't there. This type of price action is what analysts call price discovery to the downside, where the market is actively searching for a floor. The bounce yesterday on November 15th was positive, closing up over 1%, but it remains to be seen if it's just a temporary relief rally before another leg down. To get a better sense of the very latest price action, let's switch over to the 15-minute chart for the last few days. This view shows us the intraday battle between buyers and sellers in high definition. We can see the major legs down that occurred on November 13th and 14th, with steep, unrelenting selling pressure. Following the low point around $94,000, the price has entered a clear consolidation range. This is a classic sign of market indecision after a major move. The top of this short-term range is acting as resistance around the $96,000 level. Meanwhile, the bottom of the range around $94,200 is providing immediate support. A breakout from this range on the 15-minute chart could signal the next short-term directional move. Volume has tapered off during this consolidation, which is typical. Traders will be watching for a spike in volume to confirm any breakout or breakdown from this tight channel. For now, the price is simply coiling, building up energy for its next move. This microview confirms what the daily chart is suggesting. We are at a critical inflection point. Coming back to the daily chart to put it all together, let's recap our key levels and potential scenarios. To the upside, the first major hurdle is reclaiming the $100,000 psychological level. Getting and holding above that would be a significant win for the bulls and could signal a reversal. To the downside, the line in the sand is the support zone between $94,000 and $95,000. A daily close below this area would be a very bearish signal, opening the door to the next major support level identified by analysts around $87,800. So, what are the reasons to be bullish? The price is at a historically strong support level. It aligns with the estimated cost of production, and long-term institutional outlooks remain positive. This could be the buy the dip opportunity many have been waiting for. The reasons to be bearish are more immediate. The trend is clearly down, momentum is with the sellers, and the macroeconomic picture is filled with uncertainty. The failure to hold $100,000 was a major technical breakdown. Here are my unbiased predictions. Scenario 1. The bearish continuation. I believe there is a 60% chance we see a break of the $94,000 support in the coming week or two. The macro headwinds are strong, and such a violent breakdown often requires a deeper capitulation before a true bottom is found. This scenario is reinforced if we see more negative news regarding interest rates or weak performance in the broader stock market. Scenario 2. The support hold and reversal. I'd place a 40% chance on this scenario. For this to play out, we need to see buyers step in with conviction, holding this $94,000 to $95,000 level and pushing the price back towards $100,000. Positive news, like a surprise dovish signal from the Fed or a reversal of ETF outflows, would strongly reinforce this bullish case. The key things to watch are the Fed's commentary, daily candle closes around this $94,000 support, and volume flows. A high-volume bounce is what bulls want to see. A high-volume breakdown is what bears are looking for. The market is at a crossroads, and the next few days will be absolutely critical in setting the direction for the remainder of the year. Please remember, this content is for informational purposes only and is not financial advice. Cryptocurrency markets are extremely volatile, and you should always do your own research before making any investment decisions. Thank you for watching Explain the Charts, and be sure to subscribe for more in-depth analysis.